we had a Fed meeting yesterday. Okay, it was their December meeting. And we learned from Jerome Powell that interest rates will probably never be raised again in my lifetime.
Hello there, my friends. Chris Marcus here with you for Austrian Economics. And following a Fed meeting, it's quite an honor and a pleasure to catch up with my friend Michael Pento, who I talked with last year. And Michael, great to have you back on the show. And with all the Fed circus going on, hopefully you're breathing, staying relaxed, and finding some fun in it. How is everything going with you today, sir?
Thank you very much for having me back on the program, Chris. Things are going well. Buckle up, though, because I think 2020 is going to be a really interesting year.
Yeah, and perhaps a great place to start, maybe if you could give us a forecast of what you're expecting and what folks might be well served to be watching out for next year.
Well, I got to tell you, you have your forecasts, and then you find out through a tweet that your forecast is has to be completely changed. So let's take for example. So we had a Fed meeting yesterday. Okay, it was their December meeting, and we learned from Jerome Powell that interest rates will probably never be raised again in my lifetime. So Jerome Powell wants to see that 2% goal of inflation, the way the Fed measures inflation. So even though core CPI, the core consumer price index, has been above 2%, the Fed's own asinine target, for almost 2 years, the Fed doesn't look at CPI, which, by the way, is put out by the Bureau of Labor Statistics. It's not some kind of crazy investment house that puts out an inflation figure that's way above where it really is. Then they don't look at that. They look at something called core PCE deflator. Okay, but that came out and it's at 1.3% year over year. So Jerome Powell says that we're way below the Fed's 2% target. He is not going to raise interest rates until we get 2% plus some figure, and he has to get it there the way the core PCE deflator measures it. It has to stay there for a very long time. Now, I mean, I don't know how it's going to get there. I don't know how, because the Fed can measure inflation, Fed or the government can measure inflation any way they want to. They can take out anything they want to, and they do. They don't measure home prices. They measure owner's equivalent rent. They don't measure stock prices. They don't measure asset bubbles. They measure things that don't go up, and then they take out the things that do. And they call it trim mean. They have all kinds of crazy ways of, I don't want to get into the weeds on this program. So anyway, so the dollar was weakening yesterday, and then you have Christine Lagarde, who just took over the ECB. She had a meeting today, Thursday, on the recording of this interview, and she turned out to be, in my opinion, a hawk. She was much more upbeat than I thought she would be. She said inflation in the Eurozone its target would be 2% or a little bit below, which is exactly what Mario Draghi had. And I thought she could possibly be someone who made 2% a floor. But no, 2% was a hard ceiling for her. So the dollar tanked, gold was soaring this morning. And then you get a tweet from Donald Trump that, guess what? We're close to a trade deal. We had a trade deal October the 11th that was a wonderful soybean deal, and Li Hu, who was the representative from China, said, he stood there and was like, what did we agree to exactly, Mr. Trump? And Trump said, you agreed to $50 billion worth of soybeans tomorrow. And then that turned out to be just a showman, a carnival barker's play that we saw in the White House. So then we didn't have a deal. Now we do have a deal, and supposedly we're actually even canceling. And this could be true. How about if we cancel half of the tariffs that are already in place? And in that case, we see today the dollar soaring, gold tanking, and 10-year bond yields soaring by 10 basis points. So That part is hard. Headline reading algorithms are sending the market all over the place. But that's why you have to have a model that looks at longer term. Longer term, I think growth is extremely hampered by and restricted by the $255 trillion worth of global debt. That is putting a big cap on global growth. We also have the fact that central bankers have gone all in, and there isn't much room on the fiscal and monetary policies to do anything really at all. So you have slow growth, and you have a quality of what I think is disinflation for the most part in 2020. So that's what I'm looking for. And so you're just on watch now. My model, I am on watch for the credit market to freeze. When the credit market freezes, the stock market will go into free fall, and that's what we're really waiting for. But until then, we'll just, in a very hedged, carefully designed portfolio, ride this wave of euphoria up to however high it goes, and however high it goes, that's from where it will crash from.
Yeah, and I saw we climbed to new record highs as Trump's tweet went out that the trade deal is near today. So appreciate you mentioning that, and especially in your position where you're managing portfolios, helping people to understand what's going on. How do you handle that where you have market goes up or down based on, is it really just taking a step back and not letting the noise affect you too much? Or what do you say to folks on that?
So I have the model, the 20-point model tells me where we are as far as inflation, deflation, and growth and recession is concerned. So you just rely on those cyclical and secular components to tell me how to invest. So you cannot invest by just reading headlines, because you will destroy yourself and your clients. That is an impossibility. Because like I said yesterday, you would have been all bullish on the gold and really bearish on the dollar, and submarined, actually would have your legs taken out of you. Today, if you were happen to be just long gold and short the stock market, you would have been destroyed today. So the market's up over 1% as of this recording. But that could change, because Trump can change. But listen, the real issue here, Chris, is we are not, like I told you before, this is not a function. The global state of anemia, as far as global growth is concerned, is not a function of a trade war. That is not the real reason. The real reason is debt, demographics, and asset bubbles in the developed world. Period. That's it. So if you can focus on the fact that the stock market in the United States has never been more expensive in the history of records, okay, in the entire history of the stock market, since the Buttonwood Agreement was signed till today, the stock market has never been more expensive relative to the underlying economy. You understand that construct. You understand that we have an earnings recession, or there is no earnings growth here in the United States. If you understand the fact that GDP growth has has descended from where it once climbed to over 4% to now under 2%. So you have very slow economic growth, no earnings growth, and record high stock prices. You have to be cautious. So if you can make money for your clients, still being long, but in a hedged portfolio, this way you don't have to worry about wild spikes in volatility. You keep your Sharpe ratio very, very beneficial for your customers. And that's what I try to do, and I'm the best of my ability.
And fortunately, as people can see in the backdrop at Pento Portfolio Strategies, which is pentoport.com. And Michael, obviously you talk a lot about the gold market. Something I've thought about is that we actually have a lot more money and debt in the system than when we reached the $1,900 high in 2011. Whether the rest of the world is realizing that or not yet, probably not. But what does it take? I mean, the actual numbers support a much higher price, perhaps, if you look at all the money that's actually out there, yet still around 1,400, 1,500 range. What does it take to get past that 90 or get close to 1900 and surpass that?
Well, if you just look at that calculation of the supply of dollars divided by the ounces of gold, I mean, gold should be over $6,000 an ounce. That's the only calculation you're going to use. That's where I think it's eventually going. But that's not how you invest. You don't invest for, I don't invest for someday. I call that someday investing, or what should be happening investing. I don't do that. So I want to make money basically as often as possible, rather than say, I'm just going to buy some gold, load up on a ton of gold and silver and just keep it there. And someday I might be right. Now, let me just caution you saying, I always think you should have some amount of precious metals in your possession. I think between 5 and 10%. That's a floor. That's the minimum, especially of gold, physical gold in your possession. Right. So that's your baseline. That's where you start. But then you go from there and say, well, when do I want to overweight gold and silver? And when do I want to own the mining shares, which are a leveraged bet on precious metals? So it's very simple. For me, it's very simple. I want to see falling real interest rates and a falling US dollar. Now, you had that for a little while yesterday until Trump came out with his tweets. But if you can spot when this dollar, which I believe is in a topping phase, when the dollar tops out, starts to decline against the euro and the yen primarily, and you see the Federal Reserve lower interest rates back to zero, so it will match that of the ECB and the BOJ. That's going to happen, by the way, when U.S. growth slows significantly enough that it catches Jerome Powell's attention. Now, you just saw today a rise in initial unemployment claims, an absolute spike above 255,000, which is, I think it was like a 7-year high, a spike in claims. So, or 7 year or 7 month. That just makes a big difference. But I'm going off of memory here. But it was a huge spike significant spike in jobless claims. Let's just leave it at that. That's a fact. So we understand that's one of for me, that's one of the key indicators to let me know when the U.S. economy is going to dramatically decelerate. Up until now, claims have been, at the pace where they were in the 60s, around 200,000 initial jobless claims. And the non-farm payroll number that we had for last month was headline number was strong, but the year-over-year growth rate is still falling. That's the most important number to look at, the year-over-year change in non-farm payrolls. That's still decelerating. So I believe the job market is in the process of deteriorating, albeit outside what happens with the trade war. Once that thing gets settled, then I think we're going to be back to reality. And a decelerating economy, a falling US dollar, falling nominal rates, falling real interest rates, and that would send, in my opinion, rocket fuel for the precious metals. Not just my opinion. That's what historically has happened.
Yeah, I certainly agree with you there. Been waiting for a while, and it's nice what you point out, how there's that component where you can wait on your gold and silver, but also things that can be done in the meantime, which you help folks do. So last question before we wrap up. I heard from your assistant yesterday that you're not as big of a silver fan. I'm kind of going overboard on silver, but I thought it'd be great to get your opinion on that, present perhaps another side or just some things for me and my audience to think about.
Yeah. So I normally, here's think of it in tiers. So you always have some kind of precious metals in your possession, primarily gold, because gold is money. I don't consider silver money. I consider gold money. And then you go from gold, physical gold possession, to the mining shares of gold. And then if you really want the ultimate leverage for precious metals, own a silver miner. That's, that'll go, as you probably know, you're laughing because it's true. So if gold and silver is in a bull market, own a silver mining company and you'll make a fortune in a bull market. You'll also lose all your money in a down market. So if I see an environment where inflation is accelerating, okay, so the rate of change of inflation is accelerating, and we have, because silver is an industrial component, if we have rising global growth, especially in the emerging markets, that is when you become very, very wealthy owning silver mining stocks and the metal itself, AG. Okay, so are we there right now? I don't think that's the environment we have right now. I don't think we have accelerating global inflation. This is actually, if you look very, very short term, we're in a very short cycle of inflation, which will roll over in Q1 of next year. So up and now into the next few weeks, you might see some accelerating inflation. But when you get the year-over-year comparisons in January, February, and March of last year, no. So silver is not my favorite investment right now. I would still head for physical gold at the moment, but then I would change once I see nominal GDP fall in the United States, and that is a Q1 2020 event.
Well, we'll have to bring you back on the show as we get a little closer to that point, and perhaps just in wrapping up, you can let folks know how they can find you and contact you so they can stay up to date.
Okay, so the website is pentoport.com. You can come to the website and get a free trial subscription to my podcast called the Midweek Reality Check. I'll give you some very 36,000 foot overview of the market. Also, if you want to have me manage your money, it's $100,000 minimum. And if you're interested, you can call the office at 732-772-9500 or email me directly at mpento@pentoport.com.
Well, I appreciate that, Michael. You've been a great Austrian teacher to the community. I've learned a lot from you over the years, and I'm sure your clients are benefiting from that. So again, folks, you can find them at pentoport.com. Michael, thanks for joining me today. It's a pleasure catching up, and we'll have to do this again soon.
Looking forward to it, Chris. Enjoy the holiday season. Merry Christmas, Happy New Year.
All right, thank you, sir. You too.